Are you ready to take control of your wealth and design the life you envision for yourself and your family? Welcome to Wealth of Insight with Austyn Whittenburg from Whittenburg Wealth Partners. Austyn guides you through the entire planning process to help you build a plan that seeks to protect your financial future. He empowers you with creative investment opportunities and planning ideas to help you understand and achieve your long-term goals. It's time to gain confidence in your financial future. Now, on to the show.
Welcome back to the Wealth of Insight podcast. I'm your host, Austyn Whittenburg, and today we're joined by Wendy McConnell. We're going to talk some last-minute tax saving tips. Isn't that so exciting, Wendy?
So much fun. I cannot wait.
It is that time of year, and we're sneaking this episode in right under the deadline here. I have a few weeks left to make some of these changes. So before we get into some of the things we can do to save on your taxes, there are a few changes to taxes this year that I wanted to go through first. Wendy, do you want the good news first, or do you like bad news first? How do you like to approach that?
I like to get depressed first, and then I want you to cheer me up. So give me the bad news.
Okay, perfect. We will start with the bad news first. There's a few things that are happening this year that are going to make, for most people, are going to increase the amount of taxes that they owe. So we never like to hear that. But coming out of the pandemic, they put together in 2021 the American Rescue Plan. And as part of that, there was a few tax benefits there that helped people on their taxes sort of to survive, help with the pandemic. First of which, for those, and now this one only applies to people with children, but that happens to be a lot of people in America.
Sure.
So the child tax credit is going to be reduced. So during COVID, during that American Rescue Plan, they increased the amount of that child tax credit. So if you had more children, you obviously got a bigger tax credit, and that's something that's going to be reduced now. So that's going to increase your bill and or decrease your refund. The other thing that was part of that was you used to be able to, even if you were not itemizing your deductions, they still allowed you to deduct certain charitable contributions. So again, not a major thing here. They would let you deduct up to $600 of charitable contributions, even if you weren't itemizing. That's another thing that is going away. So again, not a major thing, but in both of those instances, people's tax bills are going to be higher. So now let's get to the good news. Inflation has been the biggest talking point, certainly for the last 12, maybe even 18 months as we get in here to 2023. Yeah. Some of the benefits to inflation is things like the tax brackets that we have are linked. They're not directly linked to inflation, but they do increase each year. So what that means is the tax brackets are now higher. So if you make the same amount of money that you made in 2023 as you make in 2022, you will actually pay less in taxes because those brackets shifted up. Now, hopefully you're making more money in 2023, right? Everybody, hopefully you're getting a raise, but there should be a slight benefit because those brackets have increased. The other thing that is linked somewhat to inflation is the standard deduction. And just real quick, if you don't know what the standard deduction is, that is the deduction that everybody gets on their taxes, regardless of who you are.
Unless you itemize, correct?
Unless you itemize. Yep. So that is with the Tax Cuts and Jobs Act that was put in place by President Trump back in 2016. That standard deduction took a big jump up. And then since then, it has been linked to inflation. No, it's actually been continuing
going
to
up. Okay.
Over time. So another benefit that is bigger for this year. So the two primary categories we see for clients are, if you're single, that amount has now gone up to $12,900, right around there. And if you're married filing jointly, it's now just under $26,000 that you get to take off the top of your income before you have to start paying your taxes.
So let me ask you this. Does that compare to what we've been paying out versus inflation, or are we still way under?
It's probably still going to be a little bit under, what the true inflation numbers are, but we are starting to see inflation come back down too. So that's sort of the hard thing. Things like social, we've talked about this in some previous episodes, like your Social Security benefit for clients who are taking Social Security, that's directly linked to inflation. Whatever the inflation number is, that's what your Social Security increases by. With some of these other things in the tax code or IRA contribution limits or other types of things, they're not necessarily directly linked to inflation, but they have inflation built into them that maybe it's 3%, maybe it's 5%, something in that range where each year they just go up. But when inflation has done what it's done this year, we're not going to keep up with that totally over the span of, let's say, call it 3 years, where we've got 1 year of high inflation. And then as that comes down, we start to average out over that amount of time.
But every little bit helps, right?
Yeah. $1 is $1. A penny is a penny. So anything we can save matters. Right.
And a little bit of good news is eggs I was paying 7 something now is back down to 5 something. So it's still not $1.50.
Yeah.
But that's better.
We're getting there. I don't think you need to go buy chickens. I do think eggs are going to keep coming down.
Okay.
Inflation's one of those things, and it applies to taxes and it applies to eggs. And when prices go up that high, or when things change like that dramatically, it's rare that they come all the way back down to where they were, but they at least come down a little bit. And we've seen that with tax rates over the past 15, 20 years. As there's been some changes in tax rates, they've sort of gone up and down and up and down. They go up and then they come back down, but they never quite get back down to where they were at the lowest possible point. It's somewhere in the middle.
Right. Okay.
And I guess while we're on that topic now, I'm going to go back to the bad news here real quick. I know we talked.
I thought we were done.
Yeah. Sparked something in my mind. It's not this year or next year, but starting in 2025, a lot of the Tax Cuts and Jobs Act tax cuts that were put in place are going to start to expire for most individual taxpayers. So we're talking, there are some things that have some good, some bad this year, but starting in 2025, there's going to be a lot of changes. So you really want to make sure you're staying on top of that and paying attention and working with a professional, especially a CPA. We are not CPAs, so we help our clients with taxes and we sort of know how it works, but we're not the end all be all. We always refer them out to a CPA. And that, I think, is going to continue to get more important as we start to see over the next few years a lot of changes happening.
But those changes could also be changed again before they actually go into effect.
Yes.
Okay.
Exactly.
So
yep. So yeah, it's an ever changing thing. And we've seen, with the current administration, they've talked about changing taxes, haven't done anything yet. But there will be, I'm sure, as with most things, Congress doesn't do anything sort of until they're forced to. So they wait till the last second, and right as things are going to expire, they're probably going to make some changes. But most of the strategies we're going to talk about today are things that haven't changed in a long time and are not things that I foresee changing, even if they do start to make changes. These are things that have been around for a long time. We've been doing for clients for a long time. So again, $1 is $1. Anything we can do to help clients save on taxes, we want to try to do.
Yeah, saving some money, Austyn. Let's go.
Yeah, so let's go. Okay. The first one, and this is a really common thing. Let me just say what the common thing is here. The common thing is making an IRA contribution. So if you have an IRA account, you can make a contribution, even though we're in 2023, and still get a deduction on your taxes for 2022. And there are reasons you want to do that. Maybe 2022 was a really big income year. You don't think 2023 is going to be as big of a year because of maybe we're seeing a lot of companies with layoffs or other things, but people did well in 2022. That's a really big thing. Now for 2022, the contribution limit was $6,000. And for a lot of people, they really don't have their IRA because they've got a 401k. I'd say most workers have a 401k unless they're self-employed, and we'll get to self-employed people here in a minute. But if you're a worker and you have a 401k, there are actually limits on you being able to use the IRA as well. So we always want to do as much into the 401k first as you can. But if you didn't max that out in 2022 and you're still trying to save money on taxes, you can make an IRA contribution. As I mentioned, if you have a 401k, there are some income limitations. And so really where we're finding for a lot of clients it still fits is by making what's called a spousal IRA contribution. So I'm just going to run through real quick what the limitations are. So if you do have a 401k at work and you're contributing to that 401k, then your adjusted gross income needs to be less than $109,000 in order to be able to make a IRA contribution. So $109,000, that is a big number, but a lot of people we're starting to see are making over that six-figure number. So if you're right around that number, let's say you make $125,000, your adjusted gross income is $125,000. You can then not actually put money into your IRA because you're above that limit. But what you can do is put money in for your spouse. So if you are married and you have a 401k, your spouse can still contribute up to that $6,000 number, or $7,000 if you're over age 50, as long as your AGI is less than $204,000. And so that now takes a big step up, and a lot of people are now under that $204,000 limit. So it is a little complicated, and you want to make sure as you're making that contribution, whether you're working with an advisor or you're doing it yourself, you have to make sure you say, hey, I want this to be for 2022, and you need to let your tax preparer know that you've done that. But that's something that can really help. You get a $6,000 deduction. And again, it's that spousal IRA piece that we find is most useful because that income number takes a big jump up there.
So the adjusted gross is after the 401 contributions and medical, or before?
So for self-employed people, they still have that same option to fund those IRAs. But if you're self-employed, you can also set up your own retirement plan with your business. Most commonly, people are using what's known as the SEP IRA. And with the SEP IRA, you can put actually up to $61,000 in your SEP IRA. So quite a bit higher than that $6,000 or $7,000 number, right? You can get up to $61,000 in that plan, which can be a huge deduction. And really, we find for most of our self-employed clients, they're doing that. Even you can do that up to the filing extension deadline. So we have a lot of self-employed clients where we're not even funding those accounts till middle of the summer because they've filed an extension, and you can really stretch out how long you've got to be able to make that contribution, again, still to deduct it for the prior year. And with the IRA, I should say, the contribution does need to be made by the time before you file your taxes. If you've already filed and you still want to do that, you just have to file an amendment. So you just work with your tax preparer there to make that amendment. But that SEP IRA can be really powerful for self-employed people. The last piece here on these deductible contribution side of things is by using your HSA. So if you have a high deductible insurance plan and you have an HSA, you're most likely contributing similar to you would do in a 401k, sort of out of your paycheck, each paycheck, some money's going in there, but you may not have maxed it out, and you still have the ability to contribute to your HSA in 2023 for 2022. Again, you just need to make sure that you let your tax preparer know and let your HSA company know that if you're going to make a one-time contribution that you want it applied for last year. And depending on if you're single or married, the limits vary there, but there is still some room. And that's a really powerful thing. I know we've talked about HSAs in the past too, but having that money go in to get a tax deduction and be able to be used tax-free is really powerful. So if you haven't maxed out your HSA, but you're going to have medical expenses, that is still a place you can go and to save money on your 2022 taxes.
There's something here that I think a lot of people will be interested in. A home office deduction?
Home office deduction. Yes, this is something. Now, it's a little tricky. You want to be careful here. In the past, people have sort of shied away from this deduction because they think it is an audit risk. But with so many people working at home, if you have a home office, you can qualify for that, right? So again, you're going to need to be self-employed. You're going to need to be itemizing deductions, which we'll get into here in a minute as well. But if you have a home office and you're working from home, you can deduct. And the way that they do it is a pretty basic formula. They just look at what's the size of your office compared to the size of your home. And that ratio, they allow you to deduct that. I would recommend if you're going to go with the home office deduction, I do think you want to be working with a CPA to make sure that you're doing those calculations right and including everything that can be included. But with as much as people are working at home now, it's really, in the past, I think it's been an underutilized deduction that I think really you can easily justify and qualify for today.
Did you say that you have to be self-employed in order to?
Yes. If you're still a W-2 employee, but working from home, you're not going to qualify. But if you are self-employed,
okay,
then you'll be able to qualify for that deduction. And so we've mentioned itemizing deductions here. We've talked about the standard deduction and how high that has gotten now, but I still think it makes sense to at least run the numbers for most people, especially if you live in a state with high taxes. A lot of places in the Northeast, California, some of those states that have high taxes, it can still make sense to itemize. And if you own a home, you get to deduct things like your mortgage interest and property taxes qualify in that. Now, there are some limits. So again, work with your CPA to figure out what the limits are. But if you can if you can find that the taxes that you're paying, the interest, your charitable deductions, if all of that goes up and above your standard deduction, then it's going to make sense to itemize. Too often I see people just assume, hey, I'm just going to take the standard deduction, and they haven't actually gone through things. Or you mentioned medical, I think earlier as well. Medical deductions still apply as well if they're above a certain limit. So if you're someone who's had a really rough medical year, that's obviously terrible, but it might be able to help you on your taxes. You might as well take advantage of that. So I do think it's at least worth looking at what your deductions could be if you choose to itemize, especially if you do make charitable contributions, if you own a home, and if you live in a high tax state, most likely you're going to go above and beyond what you're getting just with that standard deduction. And if you're not, this is something that maybe isn't necessarily for this year because it's too late. But if you are someone that makes charitable contributions, then bunching those contributions into 1 year is something that can help you get above that standard deduction number to be able to actually get a tax benefit for those contributions. So again, you wouldn't be able to do this now for 2022, but if you are somebody who's making charitable contributions, the way that you do that is if you're going to, it's about the same amount every year. So in 2023, you're going to give 10,000 or whatever the number is. And in 2024, you're going to do the same thing, but that doesn't get you above the standard deduction. If you make both of those contributions in the same year and start essentially gifting to charity every other year, but getting them all combined, then you are able to actually deduct those because now you're going to start tacking a bigger number on to your itemized deductions. So something to keep in mind if you are bunching or if you are making charitable contributions, that bunching strategy is something that can actually help you get tax credit or tax deductions for those charitable contributions that you make.
Do you guys work with the government to make it so confusing that we have to get a tax guide?
Yeah, there's got to be some collusion there, right? Between the CPA industry and the government to make it as confusing as possible. Yeah, it really is. Our country's tax code is much more confusing than the rest of the world's, it seems. There's pros and cons to that. Pros are you still have the ability to do all these things to try to drive your number lower. So it's nice to have that flexibility, but it does get confusing. And to a certain extent, most of the people who can actually take advantage of it are those who have the means to, which isn't everybody, right? But it's nice to have some options still. And even up until tax filing day, there's still these things that you can do to have an impact on your tax bill.
Well, thank you for the tips, Austyn.
Yeah. Thanks for joining me today. If you have any questions or you'd like to learn more, please check out our website at wittenbergwealth.com, or you can text me at 801-839-7056. Please remember to subscribe to the Wealth of Insight podcast and share with your friends and family.
Thank you for listening to the Wealth of Insight podcast. Click the subscribe button below to be notified when new episodes become available. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Stratos Wealth Partners, a registered investment advisor. Stratos Wealth Partners and Whittenburg Wealth Partners are separate entities from LPL Financial. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Whittenburg Wealth Partners. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.